Our next speaker is Mr. Siddhartha Das. Okay, he's here. Zonal Head of UTI AMC. Mr. Siddhartha joined UTI AMC in 2008 and developed a strong PSU franchise for the AMC. He will share his thoughts on the new India and opportunities in a VUCA world. Okay, over to you, Mr. Das. Thank you. 30 minutes.
Good afternoon, everyone, and on behalf of UTI, I wish each and every one of you a very happy new year. It's great to see the energy in this room. I think a lot of hard work has been done by MFDEC in their new avatar, and I congratulate them. And thank you for giving us this platform. It was wonderful. I mean, the list of speakers is really impressive. It was wonderful to hear Mr. Samir Arora and Mr. Mohanty. In fact, it was a little bit of a fanboy moment for me when I heard Mr. Arora. Back in 1995, my first 500 rupee SIP was in Alliance 95. So that was a bit of a fanboy moment for me. And taking from where Mr. Mohanty was doing his presentation, do I have my presentation loaded? Oh, I have. Yeah, we have some people from our team. Yeah, so he's coming. Delay, but we are good to go now. So, taking forward from what Mr. Mohanty was saying about the Indian economy, the growth of the Indian economy, I think my presentation is on the same, on the same lines, which is the new India and opportunities in the VUCA world. Now, what does VUCA stand for? VUCA is essentially volatility, uncertainty, and ambiguity in the current world in a scenario. And how do we take it forward from here is what I would like to briefly discuss upon. If you look at the Indian GDP, the per capita GDP over the last 20 years, there has been a phenomenal increase of almost 5x, whether it is the per capita GDP or the nominal GDP. This has been amongst the fastest growing economies in the world over the last 2 decades, and this has ensured that we have raised to the number 5th position in terms of global GDP from the 13th position over the last 20-odd years. In terms of per capita GDP, however, India still ranks below Sri Lanka and Bangladesh. Now, if you look at this from a purely, absolute terms, while we are at a lower level, but in terms of the headroom that this gives us for growing over the next 10 to 20 years, there is a phenomenal headroom that India has for growth because of the sheer denominator effect. We have a huge population, and it gives us a huge headroom to sort of grow in this space, which is per capita GDP. As I mentioned earlier, we are the 5th largest economy in the world, and in terms of Japan and Germany, we are within striking range of Japan and Germany as an economy, and would be expecting to overtake them in the very, very near future. While currently we are at about a 3 trillion economy, we are looking at the next 10 years, which should be which should have a much higher growth rate as compared to the last 75 years, that's the last 7.5 decades, and we are expected to be a $6 trillion economy by about 2030. We have this grouping which is the BRICS nations, and if there is a comparison, which is there with the BRICS economies versus the G6 economies. The BRICS economies are expected to overtake the G6 economies by about 2040. And India is expected to ride this wave in a very, very significant manner. The Indian car that you can see in the second row is expected to overtake the Japanese economy by somewhere in between 2030 and 2035. This is just about setting an expectation of how we are looking over the next 10 years. And within this the consumption story in India, which is about 50% of the GDP, is expected to grow at a phenomenal rate. And that's the base effect that I'm talking about. The huge population that we have lends itself to a huge growth story over the next 10 to 15 years. Also, this consumption-led growth that India is expected to have is the least in terms of volatility in the global scenario. That lends itself a lot of stability to the Indian economy, because the drive that we are seeing from the Indian retail space and the consumption story is impacting the economy in a very stable manner. Coming to demographics, and I think one of the speakers earlier mentioned about demographics of the Indian economy, I think one has to keep in mind that how do demographics, which is one of the very critical factors of production that we learned in economics way back in class 9 or 10, how the demographics of India stack up with respect to the rest of the world. Now, India is experiencing a period of demographic dividend. It is a period wherein we have a working population which is growing at a reasonably good rate, and the dependent population percentage is coming down in the economy. What that in effect means is that the population which is going to contribute to the economy is contributing more and more, which is leading to that demographic dividend. Now, India is expected to have a demographic dividend period of about 37 years till about 2035, which is amongst the highest in the case of any other country. Now, Japan was the highest, which had it from 1964 to about 2004 for about 40 years. But India is close to about 37 years, which we expect the demographic dividend to go up to about 2050. Again, another statistic on the demographics of India. The average median population of India is less than 10 years from that of Brazil, and from China, and about 5 years lower than that of Brazil. Again, implying that our working population is extremely, is much more as compared to our dependent population, which further implies that they make a more positive contribution to the GDP. Urbanization also in India is higher, and we are expecting that about 2031, we are expecting a population which is more than that of the US to be staying in urban centers in the country. We have a host of smart cities coming up, a lot of initiatives happening in the economy to drive smart cities, give them good infrastructure, and that should also drive up the momentum in terms of the economy. The quality of manpower is also very significant in terms of driving economies, and we have seen a huge enrollment in terms of education in India, with about 40% increase between the period 2011 to 2020. Girl children also increasing by about 60%. That lends a lot of talent into the working population, which will also help drive the economy. While we see a lot of basic access to let's say toilet facilities or education, whether in rural or urban areas, that is more or less being completed by the government, there is a gap in terms of the discretionary spending, let's say for two-wheelers, or let's say for consumer durables or cars in India, which again gives a huge headroom for discretionary spending in the future, because that is where a lot of movement will happen in terms of the domestic consumption. The gross enrollment in higher education is also gone up significantly, leading itself to a higher educated talent pool, a more talented set of population to grow to contribute to the economy. Now, bringing this to the VUCA world, this was a term that was coined by the US Army Academy in 1987. When they were training their army staff, their soldiers, wherein they were trained to look at the future, to look at the war, to look at a war-like scenario wherein there is a lot of volatility, there is a lot of uncertainty that plays out in any situation, there is a lot of complexity which one needs to take into account before taking decisions, as well as there is a lot of ambiguity. Now this is important in today's environment, because the growth that we are expecting to happen in the Indian economy will lend itself to a VUCA environment. There will be a lot of change that will happen. The speed of change will go up. there will be an ability to, we need to have the ability to predict the future as well, because there will be a lot of uncertainty. As Mr. Mohanty mentioned that, you know, a great footballer will be knowing where the ball is going to be. So we need to predict what is going to happen, how things are going to play out. We need to be updated ourselves. There is going to be a lot of complexity overall with a number of factors and their interrelationships between each other. There will definitely be lack of clarity, and in that environment is what we all need to sort of work, function as asset manager, as manufacturer of products, as well as distributors, because this is something that you will be always facing. Questions from your customers about the changes that are happening, questions from your customers about what to expect in the future, and this is something that we all need to be preparing ourselves to face in the future. So there will be, so in the VUCA world, we have to move from there is no other alternative to there are relative alternatives. You know, we need to keep in mind that there are a lot of relative alternatives which are available in the market, which we need to decide upon after taking due consideration of what all other factors are available in the market. So while there may be too many variables, there may be correlations, there may be unclear relationships, but we need to ensure that we move to alternatives that are relatively better off to the alternatives that are available. For that, again, as I said, we need to upskill ourselves. We need to ensure that we are prepared to face the customer. Now, how does the VUCA environment play out in the investing world? So if you look at the volatility that we are expected to sort of face in the future, one of the important things that we need to tackle volatility with is of asset allocation. We need to ensure that we keep a close eye on asset allocation, whether it is debt, whether it is equity in the financial services sector, or whether it is other asset classes like gold or real estate or whatever. So we need to ensure that the asset allocation is taken care of properly, because that is the mantra to take care of volatility. Similarly, to take care of uncertainty, what is important is that we need to diversify. Again, the diversification is key, because it is important that different investment classes are evaluated basis their strengths and weaknesses, and as Mr. Mohanty mentioned about risk mitigation, we need to ensure that we are diversifying our assets, diversifying our investments basis the risk appetite of the investor. So we need to take into account their risk appetite. Complexity, obviously it requires a lot of planning. There will be a lot of complex situations which are expected, which will come up. We need to ensure that we plan for the future. We need to ensure that we are planning the communication to our clients, the engagement to our clients, because they need to ensure, they need to feel comfortable, they need to feel that yes, somebody is taking care of their investments and adding value to their investments. There is a lot of ambiguity that is expected. We expect a lot of adaptability will be coming in. You see a whole lot of products being launched by a lot of fund houses. These are, I would say, term as, you know, part of the adaptability process, because it is important that we hear the customer voice, we hear what they are wanting, and we need to ensure that we provide those products, those quality products in the market. Now, everybody needs to ensure that there is a goal-oriented plan. We need to have asset allocation to tack diversity, because in the end of the day, the volatility, the uncertainty, the complexity, and the ambiguity we need to tackle within ourselves as well as with our clients. So what are some of the VUCA movements or the VUCA parameters that we see currently playing out in the market? So we see that in the key policy rates, barring Japan, which has maintained almost a status quo on their key policy rates, all the other major economies have seen an extremely high uptick on their key policy rates. And if you look at a period of hardly about 2 to 3 years, thanks to the pandemic, there is a huge volatility which has happened in the key policy rates. And this is again for all the major economies. Now, if you look at it, currently India at about 5.9 tops the list, but then if you look at US or the EU, they are also at some of their all-time highs. However, having said that, India is perhaps the cleanest shirt in the laundry. Now, everybody is scarred by high inflation, low growth over the last 3-4 years. But however, having said that, India is perhaps the cleanest in terms of various parameters, especially that of inflation. Now, we have an inflation, but we are used to this degree of inflation. I think we have seen inflation which is much higher than this, which probably the EU bloc or the US has not ever seen in their history. In terms of the GDP forecast for growth of India also shows a very healthy trend, not in part because of the internal consumption story. So we need to ensure, we need to see this in perspective with respect to the global major economies, because India is definitely one of those spots which is doing well currently and is also expected to do well in the near and the long-term future. So there has been a lot of noise about a reduction in terms of forex reserves over the last 6 months. But even if you look at the reduction which has happened, still India is comfortably placed over other emerging markets in terms of their forex reserves. And in fact, I think the FM made a very telling comment that, building up of forex reserves is an activity, as also is protecting our economy in terms of maybe to some extent giving support to the rupee. So the foreign exchange reserve have been built up for these kind of situations, and I think the war chest is being utilized very, very effectively in the current dispensation. And India is comfortably placed in terms of forex. The other very critical parameter, if you look at it, is the external debt to GDP, which is again a very, very comfortable, India is very comfortably placed as compared to some other countries, because whenever you have a very high debt or a leverage situation, the chances of something going wrong in an economy which is sort of in a global economy which is expected to undergo recession, the chances of something going wrong is very high. So India is again very comfortably placed with respect to external GDP, external debt to GDP percentage. Valuation premiums of India with respect to the emerging markets, if you look very closely, has been growing up over the last 3 years. That itself shows a very, very strong confidence in the Indian markets. The valuation from 2000 onwards, the premium from emerging markets for India is significantly up. Even if you look at some critical parameters like earnings growth and average ROE, in fact, in earnings growth over the last 15 years, India is the best performing economy. In terms of average ROE, it also in terms of, with respect to the emerging markets, India stands very, very strongly. Both in the growth and ROE outlook with respect to emerging markets, India, again, as I mentioned in the previous slide, this is a little granular, but again, as I mentioned in the previous slide, we command a significant premium over the emerging market index. The yield curves, as you would have all noticed over the last 6 months or about a year or so, they have flattened out. Now this indicates an economy wherein there is still a bit of an uncertainty as how it is going to pan out, because if the yield curves have flattened out, wherein the long term and the short term are relatively closely placed, I think it is important to understand that there is an expectation that there can be a short-term volatility, but it also indicates that probably the worst is getting over and we are getting into a territory where inflation more or less is being managed well by the central bank, and we should expect some changes in the yield curve in the next 6 months to 1 year. This slide essentially gives you an indication of what is the markup between a Nifty 50 yield versus a 10-year G-Sec. And this slide very, very clearly indicates that as of now, the investments in debt is comfortably, is relatively better off with respect to the equity market, and with the yields at about 7.5. Again, I refer to my previous speaker. I think at 7.5, we should all grab the opportunity. With the G-Sec trading at about 7.25, 7.50, I think this is a fantastic time to look at the debt market as an investment opportunity, and we should need to educate our customers. And again, when I meet a lot of MFD fraternities, what I tell them is that please do not look at the debt mutual fund as an alternative to equity. We need to look at debt as an alternative to deposits, fixed deposits. So whenever I have been meeting MFDs, what I've been telling them is that please call up your clients, tell them if in the next 6 months, any one of you wanting to invest in a 3-year plus FD, please give you they should call you back because you have a much better, much more tax efficient product, giving you much higher returns as compared to any 3-year FD that any bank can be offering at this point in time. Again, asset allocation, I mentioned this earlier, is out of the last 10 years, we see that equity has been performing the best over the last 3 years, gold 3 times, and the importance of managing various asset classes is shown by this slide, because we need to ensure that the right allocation is done to generate long-term wealth for your clients. So all the opportunities that are currently available in the market, if you look at the current scenario right now, as in Jan 2023, we have the fixed income space, whereas I mentioned that there are favorable yields currently in the market. Please use roll down strategies, please use long duration, please use target maturity funds, hybrid, consider them, including the multi-asset fund which has gold allocation, because gold is also is an asset class which we need to keep in mind. Long-term wealth creation in terms of equity, you know, valuations are challenging. Our challenge as of now, the fund house view is that the valuations are challenged. Please consider a staggered view of a staggered approach to investing for your clients. Again, what is important, end of the day, is that execution is the key. You know, we need to ensure that first of all, we need to ensure that we are updated of the current situation, we are updated of the current scenario. We need to guide our investors, guide our clients. We have, like the mutual fund has a fiduciary responsibility, the MFDs also have an equally big fiduciary responsibility towards their clients. They are the asset managers for your clients, and you know, you need to ensure that you need to be updated and then execute the asset plan which is suitable for the current economic scenario. And therefore, we need to ensure that we take into account various economic factors, micro, macro, how the equity markets are playing out, how the debt markets are playing out, to ensure that we give the best advice. So, you know, the alpha that the advisor gives to the client is something which is actually the alpha that the client needs to realize by associating themselves with you. And that is something that I think nobody else can give. That is something that I think the MFD community is out there to sort of value add to the clients. And I wish you all the very best in that endeavor. Again, to end, we have the uncertainty, we have the ambiguity which is there in the short term, that is not in our control, but we need to go for the long term. We need to ensure that we have asset allocation, we have planning, we have diversification, and we have adaptability in the long run, which will create wealth for our clients and create trust in the system. And we need to ensure that we have more and more clients coming into and investing in mutual funds, which is perhaps the most transparent investment product for a retail investor. If we have added 1.2 crores of folios in the last 1 year, all thanks to the MFD fraternity, I think we should all need to take a target that we need to add 2 crores folios this year. And I think I appreciate all the effort that all of you have put in to get more and more clients and educate them. So thank you very much, and all the very best for the new year.